Welcome to my video Accounting Tips for Beginners. I initiated to do this video specially for beginners as I know the beginners always face a starting problem. So instead of presenting overloaded or bulk information in a single stretch, I would like to present the content which will be easily understood by common man. Today I would like to introduce golden rules of accounting. Golden rules of accounting. To ensure a standardized method of recording, the double entry rules of debit and credit are evolved. Based on this, rules of accounting are classified into traditional approach or basic rules, modern approach or derived rules. Let us see traditional approach. As per traditional approach, accounts are classified into personal accounts and impersonal accounts. Personal accounts are in the name of persons and institutions, whereas impersonal accounts are those accounts which are not personal accounts. Let us see personal accounts. Personal accounts are further classified into natural personal accounts, artificial personal accounts, representative personal accounts. Natural personal accounts. The accounts in the name of human beings is called natural personal accounts. Next, artificial personal accounts. Artificial persons do not have physical constructions in human being, but they work as personal account. These accounts are related to firms, companies and establishments. Next, representative personal accounts. Representative personal accounts represents a particular person and group of persons. Examples: outstanding wages, prepaid expenses, accrued income, interest received in advance. All these examples comes under representative personal accounts. Next, let us see impersonal accounts. Impersonal accounts are further classified into real accounts and nominal accounts. Real account consists of all assets and liabilities, whereas nominal account consists of all direct and indirect expenses and income. These are the traditional or basic rules. Based on these, the rules are explained as: personal account rule defines debit the receiver, credit the giver. Personal account implies debit the receiver, credit the giver. Real account implies debit what comes in, credit what goes out. Real account rule signifies debit what comes in, credit what goes out. Nominal account implies debit all expenses and losses, credit all income and gains. Thus, the rule for nominal account is debit all expenses and losses, credit all income and gains. From this we can say that traditional approach explains the rule based on the three accounts, that means personal account, which means debit the receiver, credit the giver. Real accounts, which means debit what comes in, credit what goes out. And nominal account, which means debit all expenses and losses, credit all income and gains. From these traditional rules, new modern rules are derived, which is called as modern approach. In modern approach, the rules are explained with the help of debit and credit. Let us see rules derived from basic rules, otherwise called as modern rules. Debit. The debit aspect of the rule implies that the basic accounting terms, that means assets, liabilities, expenses or losses, income or revenue, and capital are classified on the basis of their increase or decrease value. That means when the value of the asset increases, it should be debited. When the liability value decreases, it should be debited. When expenses or losses increases, it should be debited. When income or revenue decreases, it should be debited. When capital decreases, it should be debited. Based on this, we can say that the assets and expenses or losses should be debited when its values increases. Like that, liabilities, income or gain and capital should be debited when its value decreases. Similarly, we can explain the credit aspect also. The credit aspect can be understood through the 5 basic accounting terms, that means assets, liabilities, expenses or losses, revenue or income and capital. The credit aspect of these 5 basic accounting terms will be the opposite of the debit aspect rule. That means when the value of the asset decreases, it should be credited. When the value of the liability increases, it should be credited. When expenses or losses decreases, it should be credited. When income or revenue increases, it should be credited. When capital increases, it should be credited. Based on this, we can say that liabilities, income and gains and capital should be credited when its value increases. Like that, assets and expenses or losses should be credited when its value decreases. From this, we can conclude that accounts are classified into assets, liabilities, expenses or losses, income or revenues, and capital. Assets should be debited when its value increases, and it should be credited when its value decreases. The rule for liability will be the opposite rule of asset. That means when the value of the liability decreases, it should be debited, and the value of liability increases, it should be credited. Next, expenses or losses. Expenses or losses follows the rules of asset. That means when the expense or losses increases, it should be debited. Similarly, when the expenses or losses decreases, it should be credited. Next, income or revenue. Income or revenue follows the rule of liability. That means when the income or revenue decreases, it should be debited. When income or revenue increases, it should be credited. And last one, capital. Capital follows the rule of income or revenue and liability. That means when the value decreases, it should be debited. When the value increases, liability capital increases, it should be credited. From this, we can say that assets and expenses follow the same rule. Liability, income or revenues and capital follows the same rule. Thank you for watching this video. If you like it, you may subscribe it and mention your comments.